What if I told you two of America's strongest blue chip companies, leaders in their industries, are trading at some of their lowest valuations in years? At the current price, both stocks offer high earnings yield, which is one of the key metrics for sound businesses. Insiders have been buying one of these stocks significantly in the last few months, and a huge $70 billion stock buyback is on for another stock. Today, I am breaking down UnitedHealth Group and Alphabet, Google's parent company, why they are down, what the numbers say, why legendary Warren Buffett often looks out for high earnings yield stocks, and finally, whether it is time to buy the dip. Let's go. Hey there, I am Palani, a technologist turned investor and an early retiree. I share my experience from 20 plus years of investing in US and India. This material is for educational purposes only, not a buy or sell recommendation. Do your own research before investing. Watch till the end to understand opportunities and risks associated with these two US gems in the short and long term. First in our list, United Health Group, UNH. UNH needs no introduction. It is the largest health insurer, but they are not just an insurance company. They own Optum, which brings nearly half of the total revenue, offering pharmacy benefits, physician services, and data analytics. Then you may ask why the stock dropped so much. Let's now look into it. UNH is down about 42% year to date as of July 16th, trading around $292, below its 52-week high of $630. Stock downtrend started in December 2024 when UNH CEO was shot dead in New York, and subsequent social media backlash about UNH claim denial practices. Other reasons for the price drop: 1. Higher than expected medical cost ratios. 2. Medicare advantages under regulatory scrutiny, adding uncertainty to margins. 3. Investors are rotating out of defensive stocks like healthcare this year. I believe this stock has been punished overly, though fundamental business is intact. As price fell more than 50% from 52-week high, earnings yield jumped to 8.1%. Higher earnings yield means better margin of safety. That's why it's one of the favorite metrics for Warren Buffett, who always looks out for margin of safety. Now let us look into financial metrics. In the year ending 2024, revenue grew around 8%, operating margin stood at 8%, and earnings per share was $15.51. Dividend yield is 3.2% with a recent 11% dividend hike. Free cash flow was at $21 billion and is expected to rise to $25 billion in 2025. In this current financial year, UNH expects 7 to 8% top line growth and steady margin expansion once short-term medical costs normalize. Now let us see what are some of the risks to watch out. For UNH, we need to watch medical loss ratios and any change to Medicare Advantage rules. This could impact their top and bottom line. In nutshell, UNH is a cash machine. The Optum business segment within UNH keeps growing, offsetting insurance cost swings. Optum is a clear leader in a sector with strong demand drivers that are aging demographics and rising healthcare needs. Insiders have been buying this stock significantly, demonstrating confidence in the future of the business. In the short term, say next 6 to 9 months, you may see some volatility. If investors can hold this stock for 1 to 2 years, collecting around 3% dividend in the meantime, they will be rewarded handsomely. Next stock in our list is Google. Google is down roughly 12% from its 52-week high of around $209. When we recommended Google in the middle of May, Stock was at $165 and has gone up to $185 now and is still has room to grow. Stock got beaten up overly due to following reasons. 1. AI disruption fears. Competitors like OpenAI and Anthropic could threaten search. 2. Ad market volatility. Marketers are cautious, especially when the global economy still in uncertainty. 3. Heavy investments in AI and hardware may impact their returns in the short term. Now, let's look into financial metrics. In the financial year 2024, revenue grew around 14% to $350 billion. Net income was at $100 billion. Strong margins of 31%. This is something I love with Google. Margins have been consistently improving since 2022. EPS came at 8.04. The two key businesses, Google Cloud, now profitable for 6 quarters, generated revenue of $43 billion in financial year 24, demonstrating 24% year-over-year growth. YouTube ad revenue was at $35 billion with 13% year-over-year growth. As of Q2 2025, Alphabet has nearly $110 billion in cash and short-term investments. They have announced an additional $70 billion buyback this year. Then, what are some risks that investors should be aware of? For Google, watch out how they maintain search dominance and monetize AI tools. Another important development to watch is the US courts ruling on whether Google must divest its search-related products by August 2025. If court rules to divest the search engine, it could impact stock significantly. Though appeals could delay the implementation, that's a key milestone to watch and may impact stock price in the short and medium term. Despite the AI arms race, Google core search and YouTube remain dominant. They are embedding AI deeply in search, workspace, and cloud, and that could actually defend their moat, not destroy it. In addition, Google announced $70 billion stock buyback, demonstrating confidence in the future of the business. If you got value from this breakdown, smash that like button, subscribe for more real-world investment insights, and I will see you in the next video. Until then, stay curious and keep investing smart.